Hello and welcome to the Can I Retire Now podcast with your hosts, Nick Russell and Becky Wagoner. I'm your podcast producer, RJ Malik. Nick and Rebecca, what do we have lined up for episode 6?
So episode 6, we're calling Financial Literacy, which has been the last couple episodes, but Returns of the Jedi. So it's given us an opportunity to continue to nerd out after Empire Strikes Back.
More Star Wars.
Everybody
Wars
references.
Loves
it. I can see Becky's thrilled with this.
Yeah,
she will watch Star Wars with me. But yeah, let's nerd out a little bit. But this one's going to be episodes really discuss what impacts your returns in your investments. A lot of misconceptions. So we thought we'd cover a couple of aspects of it.
Yes. So Nick and I had talked about this a little bit, and I've done some research on some terms. But to me, the easiest way to understand it was kind of through food terms, because I like food and I like cooking food. And so I don't know if you guys remember the infomercials for the rotisserie chicken machines where everyone was like, set it and forget it. So retirement, Nick told me, is not like the set it and forget it. You should not just do it once and walk away and hope it works out in the end. And then it's also not like a risotto where you have to stand there and stir it constantly and worry about it every day and check the markets and everything like that, right?
Yeah, I like that. Okay.
And so
I'm getting hungry, but I'm with you so far.
Well, okay, yeah. Okay. And so from what we discussed, I've decided it was basically like very good barbecue, where it takes some time to set it up. And then you go back occasionally and you check it and you tend to it and you do what you need to do. But at the end of the day, after all the work's done, it ends up being amazing. And as someone that loves barbecue, it works out for me. That retirement could be like good barbecue.
I like that. I could just see you like with the big mop, like basting, putting the sauce on there on like ribs over and over.
Yeah, down. Yeah.
That's actually a really good analogy because we have people that just literally will set it, forget it. And I've met people that are like, yeah, we literally haven't looked at our accounts in 20 years. But
they're cooking rotisserie chicken, and that's no good. Okay.
And hopefully it worked out. But then when things happen, the market, the economy, it could have this dramatic effect if people aren't at least tending to their barbecue. I'm going to love that. I'm going to use that with clients. That was a really great example.
So I did some research on and I picked about the top 5 things that you need to do to make sure you have good returns on your retirement, or at least the best, set it up to have the good returns. So I remember seeing some of these words in college in my finance classes. So I'm hoping you can just refresh my memory on all of these things. So
all right. Give me one and let's see what you came up with.
Risk management. How are we managing risk in our investments in retirement?
Okay. This is a big one because I think a lot of people hear things like, oh, when you're younger, you could take on more risk. When you're older, you should take on less risk. And that, as a general rule of thumb, is the case.
All right. Okay.
Yeah. But I think risk in general has to do with the amount of really potential losses you're willing to face over a short period of time so that you can earn higher rates of return over the longer period of time. So give you an example, take a couple of years ago, the market was down 25% from top to bottom.
Yeah.
So if you invested in just the S&P 500, top to bottom, say you picked the absolute high day and the absolute low day, your account could have been down 25%. But if you were more risky and you, I'm assuming some of your terms will come up in this, you could have lost more. If you were more conservative, you could have lost less. But then when the market rebounds and is up, 50%, are you making 10? Are you making 20? Are you making 50? Are you making what the market's earning or more? And so, the types of investments, there's a lot of aspects that come into making your portfolio more or less risky. I'm assuming some of your other terms are probably
in there,
but
it's kind of like you can't win unless you play kind of thing. You got to manage how much you. No, I shouldn't make a lottery reference in the investment. Okay, sorry.
Well, and it's tough too because some people come in with an emotional. We've talked about the kind of the emotions of finances, like an emotional. Hey, I don't want to take on too much risk. They'll say something like that, but not really understand what that means. and not understand how much risk they should be taking to align with their goals. So
Okay.
like when I look at our financial plan and clients' financial plans, I actually go backwards. I figure out, well, what do they need when they say they're working now and planning on retirement? So what do they need? How much are they saving? So how much return do they need to earn on average to get there? As long as that's a reasonable number, then we target trying to take the least amount of risk to earn those returns. It's not
All
about
right.
just getting people the best returns, because
So
then they
you,
have
so
to
you
take a lot of risk.
manage the risk.
Well, we manage the risk, yeah.
All right. I like it.
All right. That
All
was
right.
first one. Wasn't too bad.
Nailed it. All right.
What's number
good.
2?
So number 2 and number 3, to me, feel like the same thing. So I need you to explain the difference.
Okay.
So, and I feel like I may know the difference, but I'm not sure. The first one is asset allocation.
Okay.
And the second one is diversification.
Okay.
And both of these feel like the same, but apparently they're different. Tell me how.
So, well, they are very similar, right?
Okay.
And I think the terms get used interchangeably. So let's talk about diversification first. I'll go with the second one first. So diversification conceptually is the idea of owning a lot of different investments so that if one does well, one does poorly, any one investment doesn't have too much of an effect on your portfolio. So kind of a simple example, let's say you owned one investment and that company goes bankrupt. You lose all of your money.
Game
Right?
over.
If you own
Okay.
4 investments, one of which is that same company, and it goes bankrupt, you lose 25% of your investment. If you own 100 investments and one is that company, you lose 1%. So that's the downside. Obviously, the upside works the same way. But I think diversification goes a little farther into our last episode. Episode 5 was about different types of taxation within accounts. I think you should diversify around the types of investment accounts you have.
Okay, but isn't that asset allocation?
So no,
Oh.
and that's where I think the
Okay.
where people get confused. So from an account level, it's diversification. From an individual investment level, it's diversification, and in the middle, it's kind of asset allocation. So
Wait.
yeah, I know.
Okay,
I
now
know.
there's a middle.
Yeah, the middle.
Okay.
So the middle, the way I and this is how I think of it. So maybe
right.
you know, I'm not writing a textbook or anything, but this is how I would.
Thank
I
goodness,
explain
I'm
to people.
lost already. Okay.
All right, bear with me. So asset allocation is simply owning different asset classes. So instead of saying I own, if you were to say Microsoft and Apple and names like that, those are large growth companies. Well, that's an asset class, you know, equities, stocks. But then there's
Okay.
medium-sized companies. There's small. There's bonds and fixed income, and tons of different kinds of bonds and fixed incomes. There's international. There's cash. So asset allocation is having the different types of categories within your investments, making sure you own different pieces of the market or pieces of that investment pool. You know, it's the old "don't have all
Okay.
your eggs in one basket."
Which is why we diversified also.
Correct. So asset allocation is a type of diversification in my mind. That's the way
fingers
I think
and
of it.
thumbs.
Fingers and thumbs. We always.
Okay.
So by the way, if this podcast wasn't called "Can I Retire Now," it was we called "Fingers and Thumbs." We just like you and me.
This somehow comes up a lot in our house. So
I don't know why, but it's probably one of those ridiculous things we find funny, and everybody's gonna be like, "Well, they're idiots." But you know, so asset allocation is having all these different pieces represented, and then going deeper than that. If you own one large U.S. stock, but you can own 10 of them, well, now you get more diversification within that asset class.
okay, you didn't explain the fingers and thumbs things though to everybody. Where all thumbs are fingers, but not all fingers are thumbs.
Here's our thumbs. Yeah, I'm
That's-
sorry. Yeah,
that's the reference.
I'm so
Sorry.
used to talking to us about it that I kind of took for granted. Yeah.
So that's the reference. Okay.
So wait, all thumbs are fingers, but not all fingers are thumbs. Yeah.
Yes. Okay. So we have asset allocation within our diversification.
Correct.
All right.
And very
Keeping-
reasonable. Those terms get used interchangeably and incorrectly. So
okay.
don't. Yeah, that's a really
All right.
common.
I'm
error.
glad you have a handle on that.
Well, thank you. Yeah.
I appreciate that. All right. The last thing, not the last thing, the fourth thing that we're going to talk about
Fourth, okay.
is long-term perspective, which obviously we hope everybody has, right? If you start investing early, you want to not be too bogged down in the middle. You want to think long-term game plan. Like we always play the long game, right?
I'm gonna take the opposite side of that.
Oh, jeez.
No. You're doing great, by the way. So if we're talking about retirement, absolutely long-term perspective, right? We're in our 40s, 20 years to retirement. You have to think long-term. If something happens in the market or in the news today, whether it's a year like this with an election cycle or a world war or anything, you can't let short-term things affect that long-term strategy. But not every goal is a long-term goal. So I would take it a step farther and say for retirement, you are absolutely correct. Wonderful. It's like the fingers and thumbs again. You know, you're intelligent and beautiful and the best.
Okay. Now you're just buttering me up. Okay.
I am because I messed up the fingers and thumbs thing, but it's okay. But let's say you have a goal that's shorter term. Mm-hmm. You should make sure that your risk that you're taking and therefore the returns you're targeting are appropriate for that goal. Think of like someone buying a house. If they go, I want to save up and buy a house in 2 years, you're by no means should take the same kind of risk or target the same kind of returns as you would with your retirement accounts because the time frame's different.
Okay. So instead of just isolating it to long-term perspective, you should really just have it as appropriate perspective for your goals.
Yeah. Like a time, let the time horizon to your goals dictate the risk that you take in that.
Time horizons. Excellent.
Time horizon. Yeah.
Timeline?
Timeline,
Okay.
time horizon. Yeah.
It sounds fancier. Horizon. Got it.
Yeah.
Okay. And the last thing, which it makes sense and probably does not need a lot of explanation, is regular review and rebalancing. So that's pretty self-explanatory, but what kind of periods are we talking about for rebalancing and reviewing that seem appropriate? Like what's too much and what's too little?
Yeah, I was going to say, I know people that look at their accounts every day, every week.
That's stressful.
They
know their logins, I bet.
Yeah,
so.
yeah.
Okay.
They never need a password reset
No.
because they're logging in all the time. But that's honestly, it's too much.
Yeah.
And by all means, be aware of what you own, but and how you're doing. But day to day, especially nowadays, there's so much movement in the market. Your account balances are just going up and down. You're not aligning your perspective, your timeline with what you're actually doing. I would say you should review your retirement accounts for rebalancing once a year.
Oh, that's it. Okay.
That's it. Could be more, but
Okay.
once a year is plenty. Quarterly is the most I would ever consider. So it's somewhere in that window. But if you're working with an advisor, you're doing a financial plan, something that you have different goals set up in there, and you're progressing towards all these at different timelines, horizons, and all that. You should do an annual review with the advisor. I mean, a lot of my clients I meet with, more than that, I meet twice a year to do mid-year check-ins and annual reviews. We send out content like this so people could just stay on top of it in the meantime. But yeah, I think people look and therefore touch their accounts way too much.
How would you consider my previous perspective of getting my statement in the mail from my state retirement system and saying, man, it looks good?
It's still there. And honestly, that's what a lot of people do.
Okay.
Nowadays, though, a lot of statements have gone e-delivery because a lot of companies charge for statements
another
nowadays.
Login. Yeah.
Yeah. Well, so now you don't get the prompt in the mail. So you could quickly become, or would have become, one of those set it and forget it rotisserie chicken people because
that was
you weren't getting the prompt.
Where I was going.
Yeah.
Okay.
So, but I do think like a quarterly statement, great. Take a look. But what are you looking at? Let me ask you, what did you look at when you opened up your statement?
Honestly, I looked at the beginning balance and the end balance. And I did look at my risk classification. I mean,
Okay.
I started my retirement account when I was 22. So we had the gas pedal all the way down. And I don't think I changed it while I worked for the state because I was still in my early 30s. So
I believe by the time I came around and saw it, it was still pedal to the
I believe
metal.
you took it out of my hand once and said, "Let me look at this. This is what I do." And then you looked at it and you said, "Well, that looks good." And I said, "Yeah, I know." Right back at
Yeah.
you. Like, I'm not.
And we continued to date after that. Wow, what
Yeah.
a great origin story.
Yeah.
Yeah, but I think most people do that, right? They look at the account balance and go, well, the balance went up,
Yeah.
and that's tough, right? Because you're contributing money.
Feels like
The
a
state was-
positive indicator, Nick.
It should go up, but there are going to be periods of time where the market goes down and forces it down. That doesn't mean you're doing
Yeah.
anything wrong.
Okay, to be more accurate, I looked at my contributions also and made sure
Okay.
it went up more than my contribution.
More than your
amount.
contributions, okay. And that's not
My
something that can happen
sophisticated
every-
level of review.
Yeah. Yeah.
So-
But it's a good start to make
Okay.
sure you're at least looking, make sure you're at least aware, and then obviously you're married to a financial advisor, but if you're working with a financial advisor, then forward that statement to them and say, hey, am I doing what I should be doing?
Yeah.
Or do I need to make any changes?
Well, good.
Yeah.
All right. So those were the top 5 things about getting the best returns on your accounts. Do you have anything?
Those are good. Those were, I think
My-
those were keywords for
My
people to be aware of.
research paid off.
You
Look
are
at me.
crushing it on the research. I got to say,
Yeah. If it's on the internet, I'll find it.
truth.
It's true.
Yeah.
Okay. So I have some did you knows
I
about
love your did you knows.
historical rates of return because we can't get enough.
Okay.
I mean, there's a lot of data in the finance world. So there's some basic account types, right, or things we're getting returns on. I don't even know how to state this. The asset? Is it, no,
Mm-hmm. Yeah,
okay.
it's an asset, sure.
So stock market returns,
Okay.
average, right? Usually you have a return on investment of like 10% before inflation.
Correct. Yeah, if you look the
All
last
right.
100 years and you take every 10-year period, kind of rolling 10-year periods, depends what index you look at, but they're at or above about 10% annualized. Yeah.
Okay. And bonds, typical good ROI is between 4 and 6%.
Correct. Now, of course, yeah, no, you're
The internet hasn't failed me. Okay.
2 for 2. All right.
2 for 2.
Nice.
Okay. And this one is kind of an interesting thing because we've talked about this before. This is real estate, which I think a lot of people are invested in for their own personal homes, less so for investment properties, but it can be a thing. Okay. After accounting for inflation between, wait, I think I have the dates wrong on this. Yeah, 1890. So this is too long. I thought it was 1980. Sorry. 1890 and 2015, after accounting for inflation, U.S. home prices rose less than 1% annually. So in terms of returns, is real estate a good investment?
Wow. I'm going to have to take a look at that, Pete, where you found that.
It might be too big of a period. I don't know if this
Well,
is a
and
good
it
did
might
you
have
know?
been heavily affected by the beginning part of that window.
the Great Depression and
Yeah.
okay. I thought it was 1980, so I was going to say because you've said to me before, real estate is kind of
It's usually about 5.5%.
5%. Okay.
Yeah.
All right, so forget that earlier piece.
But I think a good thing to pull from that is if you look at the last couple of years, home prices have gone up an absolute ton.
Yeah.
You mentioned bonds at 4 to 6%, but the last 15 years, they've basically been zero.
Bonds?
A lot of bonds have been negative since 2008, 2009. A lot of the bond market has been negative. Did you do any research on what average inflation is?
No, should I have?
No, it's okay. So I know this one. Off
I
the
know
top
we're
of my
trying
head.
to get it under control.
Yeah, well, and
That's
right
what
now,
I hear on the news every day.
yeah, they're telling you they're taking care of it, Becky. Don't worry. So this one's an easy one for you to remember, and it might have changed in the last year or so, but on average, over that same 100-year period, it's pi. It's 3.14, or has been in or
More
around that number
math.
for a long
How
time.
exciting.
I know.
Okay.
But the important reason I bring that up is if costs of goods are going up, say just 3% a year. Now, right now it's more, but over time, as you're saying for retirement, and you want to invest in a more conservative investment because you're worried about losing money, nothing wrong with that, and you pick bonds, let's say, for example, and you're getting 4 to 6%, you're actually only making the difference, 1 to
You're
3%.
eking it out there.
Barely. So people are sometimes scared of investing in stocks because they are the riskiest of these investments that we've
The
talked
most
about.
volatile, yeah.
They're the most volatile. But they also offer the highest rate of returns because of that risk. And sometimes you need pieces of your portfolio that are earning that 8, 10%, so that after inflation, you're pocketing 5 to 7%.
Yeah.
And it's not necessarily the money you need today. Again, we talked about timeline and time horizon and all that. If this is something that's money for 10, 15, 20 years from now, a lot of times you could afford to take that risk.
All right.
Was
So
that all
much
of your
information.
did you
The-
know?
the-
That was a
this
good
is
did
all
you
my
know?
Did you know? Yeah. So, Return of the Jedi.
Returns of the
Jedi.
Jedi. So I'm gonna add one thing that we didn't really talk about for this episode, but in kind of in the breadth of risk and returns, and I'm going to have you do this. So this is a newer tool I'm using with clients. I know the look on your face.
Okay.
I hope people just saw you roll your eyes at me. So I have a tool I use from a company called Nitrogen. It's a risk questionnaire, but it was done with behavioral therapists and psychologists and how they designed it. And it basically will ask you more feelings questions than math questions. So
This is like taking a quiz in a magazine. Okay.
it's like old school Cosmo, but for new age.
For finance.
But for finance. And what they do is they say, look, we're going to score from 1 to 100. Think of it like a speed limit, right? If you're driving on the road and you feel comfortable at 55, but your portfolio is going 75, that doesn't align, right? So it's been a really clean, easy way to get people to understand what their portfolio is doing and how they actually feel instead of the terms we use a lot, right? You probably have heard the term conservative, moderate, aggressive. Well, moderate, if I were to ask 100 people, I bet you 80% of people say they're moderate. But they all mean different things. No one has the same gauge on what moderate is.
So if you have a fancy quiz, you can get a real good thing on how you actually feel.
Yeah. So
Okay.
we it's available. It's on my website. It's called Nitrogen, or Riskalyze is the tool.
Riskalyze is much
I
sexier
love
term.
Yeah,
for
I love that. I love
Okay.
that. So they rebranded the company because they do all these other amazing
Yeah,
things. But
why wouldn't you Riskalyze?
But so I'm going to send you a link in your email to do your Riskalyze score.
Oh, I have my own homework.
It's going to be great. So there's homework for you. And anybody that wants to do it, they can go on the website and there's a little drop down. You can click on it. Takes maybe 5-7 minutes, but it's great. And then I'll do this with you as well. And if anybody wants this that's listening, you could also upload any current account you have, and it'll break down every single investment, tell you the individual risk score of that investment, and then your overall portfolio, what
So
it's
much
currently scored
data.
at. Yeah, no. So this is what I would do, like with, say, somebody that was referred to me or wants to be a new client. I'm going to first look at what they're doing, because I'm not going to come in there guns a-blazing and go, let me change everything. If they're doing what they should be doing, that's great news for them.
Yeah.
And I want to be able to show them that. So I'm going to have you do some homework between this episode and next to cover that. And I would encourage anybody that's out there.
Better sharpen my pencils.
Yeah, I know.
Okay.
RJ, you're included. Go
Yeah.
to the website. It's sunrisewealthadvisors.com. The tool is Nitrogen, and it's Nitrogen. and
Riskalyze.
Riskalyze. Yeah. You can click on it. Just opens up a window. Have at it. You'll get your results at the end. I think it's a really good, useful exercise.
Excellent. Nick, give the website again, please.
Sure. It's the company name. It's sunrisewealthadvisors.com.
Excellent. All right. Thank you, Nick and Becky. Very, very interesting and entertaining at the same time. Appreciate it.
Thank you, RJ.
Looking forward to your next podcast, and thank you for listening to today's Can I Retire Now podcast. Please like, follow, and share this podcast with friends and family. Until next time, for Nick and Becky, I'm RJ Malik.